Good evening, everybody. Uneducated economist here. Alan Greenspan came out today saying that the negative interest rates will spread to the United States. And he made it kind of one of these not if but when kind of statements. Got me thinking about a Bloomberg article I was reading earlier today, talking, how did that one go? The title of it was Negative Interest Rates Threaten the Financial System, I think is what it was titled. Anyway, I'll leave a link down in the description for you guys. In this article, it was pretty good because it kind of talks about where negative interest rates are going to be affecting the different parts of the economy. But I thought it was really interesting as far as what it talks about coming to the banking system, because this is where you're going to see it really start to affect everybody's lives. Now, it might go into the United States Treasuries first. This is where you'll see like a negative interest rate on like bond yields or something like that. But remember, like this is people buying into the bonds. The bond itself may not have a negative coupon to it. This is the interest rate that the bond pays. The amount that people pay for that bond exceeds what the bond will pay with that coupon. This is where the negative yield comes in. People are willing to do this on a speculation, thinking that interest rates will drop into the future and they'll be able to sell that bond for a profit. So even though it's costing them, like basically they're paying more for the bond, knowing that once they get the bond, if they held onto it till maturity, that they would not get back as much money as they paid for the bond. But if interest rates drop, they'll get a profit off of that if they go to sell it. So people are into these bonds right now because everybody is convinced that interest rates are going to be dropping into the future. And the Federal Reserve has all but stated that they're going to be lowering interest rates. So anyway, back to this Bloomberg article. Where I found it most interesting is where they talk about how the interest rates going negative would be most effective to the banking system once it gets to the interest on excess reserves. Now, typically the way a banking system would work is that the big banks like the JP Morgan, Goldman Sachs, those guys, they would have at the end of the day reserves, and some of them would have excess reserves and some of them would be in need of reserves. The one who has had excess would loan it to the ones who were in need of reserves until everybody balanced out. That lending rate is the effective fund rate. The fund rate itself is the target that they shoot for. So the effective fund rate is actually what those banks ended up lending that money for. Now, since I couldn't tell you how long, but we've basically been operating for the last, I'm guessing, year or so, maybe even a little longer than that, in something called an abundant reserve system, where these banks don't loan money to each other on an overnight basis. They all have all the money they need. In fact, some of them have excess reserves. And that excess reserves gets loaned to the Federal Reserve on an overnight basis. This is the interest on excess reserves that they get for it. Again, this is where they're shooting for that Fed fund rate to be. This is the basis for all banking. Everything after that is going to be a higher interest rate, whether they end up loaning it to you and me for a car or a credit card or a house or something like that. It's going to be more than the effective fund rate is coming from the Fed fund rate is coming from these interests on excess reserves. Once those interests on excess reserves go negative, this is where we start seeing the banking system start to deteriorate, because this is where the bank is going, oh man, it cost us money to have depositors' money. So if they have people putting money in their bank and they end up with excess reserves, they loan that to the Federal Reserve and pay them to do it. They're not going to want those excess reserves, so they're going to charge depositors interest on their deposits because they're getting charged an interest on their excess reserves. And so on down the line it goes. So just because the treasuries go negative doesn't necessarily mean the banking system has gone negative. But once those interests on excess reserves go negative, now we're going to start seeing issues within the banking system. Uneducated economist, you guys let me know.